The Federal Reserve is holding interest rates steady again. Inflation is cooling, the job market is slowing, and now Wall Street is betting on a pivot. So the question is, will the Fed finally cut rates in 2025? And if they do, when will it happen? What will it mean for your money, your mortgage, and the election coming up in November? In this video, we'll break down what the Fed is watching, what the market is signaling, and what happens next for the U.S. economy. This is American Ledger. Let's get started. As of July 2025, the Federal Reserve's benchmark interest rate remains between 5.25% and 5.5%. It hasn't moved since July 2023, a full year of holding the highest rate in over 2 decades. Why? Because of inflation. Back in 2022, inflation surged past 9%, forcing the Fed to raise rates at the fastest pace since the 1980s. The goal was to cool demand, slow borrowing, and bring prices back under control. Today, inflation is down significantly. In July, headline CPI rose just 0.1% for the month and 2.4% year-over-year. Core inflation, which excludes food and energy, came in at 2.8%. That's real progress. But the Fed still isn't satisfied. So why is the Fed keeping rates this high? Because they don't want to repeat the mistakes of the past. In the 1970s, the Fed cut rates too early, and inflation came back even stronger. This time, Powell is making it clear they want to be absolutely sure inflation is defeated. The Fed is especially focused on sticky categories like shelter, services, and wages, areas where prices are still rising more slowly but haven't stopped. They want a soft landing, where inflation returns to 2% without triggering a recession. But hitting that target takes time. And for now, the Fed believes holding rates steady is the safest course. But while the Fed stays cautious, the market is already looking ahead. Futures traders expect 1 to 2 rate cuts by the end of 2025. According to CME's FedWatch tool, there's a 70% chance of at least 1 cut by December. Some even see a cut as early as September. Why? Because inflation is easing. Consumer spending is slowing, and corporate earnings are showing signs of strain. Bond yields have also started to fall, a signal that investors believe lower rates are coming. The market sees the pause as the first step toward a pivot. Now add the 2025 election to the mix. Both parties are watching the Fed closely, and both have a lot riding on the economy. If the Fed cuts rates before November, it could help the incumbent by boosting growth and consumer confidence. If they hold or tighten further, and the economy slows, it could shift the political winds. Chair Powell says the Fed doesn't consider politics, but the reality is, any move they make this close to the election will have political consequences. So while they claim to be neutral, the pressure is real. Of course, there's a risk to staying on hold too long. If rates remain elevated deep into 2025, we could see rising unemployment, weaker spending, and tighter credit conditions. The job market is already showing signs of softening, with new layoffs and hiring freezes across multiple sectors. Several analysts, including at Goldman Sachs and Deutsche Bank, warn that the Fed may already be over-tightening. And if they wait too long, they might have to cut more aggressively later, creating unnecessary instability in markets. So what does all this mean for you? If you're borrowing, expect interest rates to stay high for at least the next few months. Mortgages are still above 6.8%. Auto loans and credit cards remain expensive. If you're carrying debt, consider paying it down or locking in fixed rates. If you're saving, high-yield savings accounts and CDs are still offering strong returns. Now is a great time to keep cash in a place that earns interest. If you're investing, the market could rally on news of a rate cut, but stay cautious. A surprise inflation jump or Fed hesitation could trigger volatility. Stay liquid, stay informed, and most importantly, don't assume the Fed is done just yet. The Federal Reserve has a tough job. Cut too soon, and inflation might rebound. Wait too long, and the economy could tip into recession. Right now, the market sees cuts coming, but the Fed isn't ready to commit. The next few months, including the August CPI report and September Fed meeting, will be critical. We'll be watching it all. If you found this breakdown helpful, subscribe to American Ledger for clear, fact-based analysis on the U.S. economy every week. Thanks for watching. I'll see you in the next one.